Hello and welcome to this latest edition of Courses on Demand brought to you by Forex.Academy. In this course, we will be discussing trading volatility. Now, there is, of course, inherent risk when deciding to trade the financial markets. So just before we begin, please do take a moment to familiarize yourself with the following disclaimer. In this webinar, we will focus our attention to trading volatility and recognize some very basic points. First of all, defining what volatility is and how it affects price action. We'll then look at volatility as an association with risk in the financial markets and look to assess it across various asset classes. Then we'll be moving on to news and economic data and actually looking through economic data points throughout a day's trading to see how it may affect the markets in question. We'll be looking at some practical examples, particularly with volatility in real time, looking at some UK assets. We have the FTSE 100 and the euro pound, as well as the pound dollar or cable market, and actually visibly observing volatility and how price action trades as a result of those news and economic data. And then we'll be finishing off by discussing asset class volatility. Obviously, as financial traders, we look to not only trade Forex markets, but perhaps commodity markets or cryptocurrencies. And there are different elements or different associations of risk and hence volatility when deciding to trade many different asset classes. So first and foremost, let's discuss and ask us the question, what is volatility? Well, volatility firstly refers to the amount of uncertainty or risk about the size of changes in a security's price. So something that perhaps has a very low volatility, perhaps trades 20 pips per day over a long period of time, we would call that a very low volatility market, where you might say something that trades 100 or 200 pips a day is very, very risky and is hence very volatile. The higher the volatility, the more price moves over a period of time, and then the lower the volatility, the less price moves over a set period of time. In general, a security is said to have a higher degree of risk if it is indeed more volatile. A security that is regarded to have a higher degree of risk will trade with a higher level of fear and uncertainty to price action changes. We can actually visibly see this volatility when market prices fluctuate more frequently and price action trades in a more rapid manner. And this is particularly evident when looking at price action as it trades in the short term. And more extreme changes in a market's trading range provide us with a physical representation of this volatility. We can assess this by analyzing the price action, and in general, if we look at a market that perhaps trades 100 pips a day on average, it's said to be much more volatile than a market that perhaps trades a lower ATR or trading range with 40 pips a day. Technical traders attempt to explain and identify this volatility by observing a securities market's average true range, or otherwise known as ATR. It's actually a very useful technical indicator indeed. Here we have three markets in front, the SPI 200, which is an equity index in Australia, the dollar index, and the euro US dollar or cable market. We can see the price action structure. All of the candlesticks there are days or daily candlestick price action structures, both 1, 2, 3. So the question I would like to pose is, just by observing the price action and the trend, which market is most volatile? Well, here we can observe volatility by looking at the candlestick structure. Is there perhaps more variance from the trend? Is there perhaps larger ranges with the candlesticks, perhaps more larger extensions of those ranges, perhaps breakouts from the trend? So many questions that you can actually ask yourself in observing the price structure or the price action as the markets trade from left to right. And obviously, the answer to this question is number one. Chart number one, we can see we have a very strong extension of the price. If I just use my pen to annotate, we can see some very strong moves to the downside, and then we see reversals within 1 or 2 days. We can see very strong pushes to the upside within one candlestick, and then reversals within each trading range again. So we see much more variance of price. Within this, you could imagine there is much more rapid movement of price in the short term, and that would lead us to assess that this market is certainly more volatile than perhaps picture number 3, which is the euro dollar, we see a much more well-conformed structured trend to the upside. The actual candlestick structures are relatively small, which would indicate the ATR is relatively small as well. We don't get a very strong candlesticks, perhaps that would indicate perhaps a 200 range. So most certainly, the market 1, the SPI 200, is the most volatile market here. So when assessing volatility within the markets, we can develop a certain risk approach. And as we look across different asset classes, we develop certain risk premiums to actually trading the markets. And this is effective with actually looking and observing the volatility within the financial markets. Here in front, we have a copper chart, again, observing the daily price action. Just another example of how a commodity may perhaps trade differently or have a different risk approach to perhaps a forex market or an equity market. And there are several reasons why. Commodity markets in general are much more consistent in terms of the trends they produce due to most important factors relating to supply and demand. So again, this is the copper market. We're looking at the daily price action. If we think fundamentally how this market trades and is priced, we know that there is a supply function of this market. Perhaps many regions throughout the world globally produce this product, and on the demand side, we know perhaps one country like China is actually a big purchaser or a big buyer of this metal itself due to the large construction industry within the economy. So it does relate very fundamentally to the supply and demand structure of the market in question, particularly across the commodity assets, and therefore is much more consistent in terms of trend structure. In commodity trading, we often witness short-term price shocks, and this can be due to short-term volatility entering the markets due to some news perhaps or some weather that affects perhaps a market like sugar or coffee. We can see this in the price action very abruptly, and it can only last and affect the overall trend structure for a short period of time. We can often see some short-term volatility entering the market, perhaps when the market is closed over the weekend, and that will effectively cause the market to gap either to the upside or downside. We can see that we have some short-term price shocks, and events like these that may occur in the market causing these gaps will actually add volatility to the market and actually increase the risk. But given the structure of a commodities supply and demand function, we could hypothetically classify this financial asset as a risk one level asset, given the volatility is much less than other assets. When assessing volatility in the forex markets, we know that they are regarded as highly volatile given perhaps an unquantifiable amount of variables that affect the price. And we can see that just by looking at the structure of the market here, we do have a very strong trend to the upside. What that particularly means that in the short term, there are many news events that come into news articles throughout the course of the day, perhaps, and we can see short bursts of price here, even in observing the markets. Basically, all of these news events will affect the volatility of the forex markets in some shape or form. The forex markets see a large and constant volume of participation. So given the amount of market participation in the forex markets, it has very strong liquidity, and these traders are always congregating to look for trading opportunities in the forex markets. They're very popular markets to trade, and that causes a surge in trading when some news perhaps enters the market. Prices with the forex markets, prices rarely trade in a straight or linear fashion. So we do not see these markets trend in a more sophisticated fashion towards the upside or the downside, perhaps like an equity market or a commodity market that is seen as perhaps increasing demand over the long term. We'll see those price structures develop very nice straight trends indeed. But because there are so many factors that actually affect the forex markets, we see them show very volatile price action to the upside and downside, and we would classify this hypothetically with the risk level 2. Just observing the structures of the candlesticks themselves, we can actually see that we have some dojis here, we have some hammers, and that is evident or perhaps explicable of the short-term volatility within the daily candlesticks themselves. Perhaps some of the more popular assets to trade nowadays are cryptocurrencies, and they are quite volatile in terms of risk association as well. perhaps because they are often either misunderstood or not understood at all as an asset class, and this leads to fear and greed entering the markets. We can see the price chart in front of us. We have the Bitcoin US dollar daily chart. It's very volatile indeed, and we can see very extreme large trading ranges. Markets here can experience very high levels of liquidity, and this is because prices are being traded very rapidly as traders buy and sell this asset. We can see it has from almost 13,000 to 15,500 in one particular trading day, a very, very extensive trading range, um, uh, almost 2,500 pips in this single trading day. And we can see that that is indicative of very fast and rapid fluctuations in price. So an asset like this, perhaps a cryptocurrency, would hypothetically get a risk level association 3 and would be much more volatile perhaps than a forex pair or a commodity or equity index. To assess the overall level of volatility in the financial markets, macroeconomists refer to a performance indicator known as the Volatility Index, or VIX for short. And that's exactly what we have here in front of us. This chart shows us the volatility level in the markets over a global scale from 1990 to 2017. So as we move across the years, we can see some very significant points in our time in history where there has been perhaps some financial instability, or perhaps some global events that would cause some real uncertainty and fear in the markets. Starting there in 1991 with the US recession, we can see the very infamous collapse of a long-term capital management there in and around 1998 to 1999. That caused a huge level of fear and uncertainty to enter Wall Street. So obviously very specific to the financial sector itself. And then we see the dot-com bubble there just after 2000 burst. And we have 9/11 and the Iraq War with some very serious global interactions in terms of fear and financial instability. And as we move across, we have the global financial crisis, which almost sees a peak of our long-term volatility index reach our 80 mark. And then, of course, the more recent EU sovereign debt crisis, which caused particularly massive instability in the forex markets, particularly with euro denominated assets. So if you're trading perhaps the forex markets in this time, you know that there's a real sense of volatility, and because that fear or uncertainty enters the markets, um, when prices move in a rapid fashion to one direction, you usually get much more of a surge, an increase in price speculation, and it causes much more uncertainty and fear in those moves. And we know that trading itself is a very irrational pursuit indeed. So when we see these increases in risk, um, assumption or volatility, asset prices can move in a very irrational fashion. Our last spike in volatility was just in 2016 there, with obviously the Brexit phenomenon. We've seen a large increase in volatility across forex assets, and particularly in equity assets relative to the UK economy as well. And obviously if you were trading any of the financial markets during those times, you would have seen large sell-offs across various asset classes as well. In looking at an approach to volatility with the volatility index, we know that we see riskier assets like equity markets, they will experience price shocks as volatility increases in the markets over the long term, and can set the tone for risk assumption in the global investment community. So here we have a good example of that. We have a bit of a correlation here with the volatility index across a 10-year period from 2008 to 2018. What we can see is the S&P 500, which is the largest equity index there in the US by market capitalization. And we can see when we do see some very strong price shocks within the volatility index here in 2016 is our Brexit to the upside, a very strong move to the upside. We can see that we have a sharp sell-off in the equity markets in particular as well. We have another increase here just after, perhaps that's the US elections. We see another sharp trading with some more fear and uncertainty entering the markets. And this is all an assessment of volatility towards risk in the global investment community. Then we see a volatility start to decrease, and obviously we see a very sharp trend. And that's currently what we're experiencing now in the markets. We know that volatility is decreasing. We're almost reaching all-time lows in the volatility index, and that's causing, as well as volatility decreases, we see a risk-on approach enter the markets, particularly in these riskier assets. We see the global investment community accepting this decrease in volatility hand in hand with an increase or level of prices in asset classes that are recognized as risky assets. We see capital flight push towards, and obviously the equity markets are continuing to move higher. This is all indicative of the amount of volatility or the amount of risk associated with trading the markets at any given period. So in assessing volatility, we know that the level of volatility in the markets will cause market sentiment to shift between both a positive or negative approach to risk. Now, in the financial markets or investment community, we call these approaches to risk a risk-on or risk-off approach. In general, market participants will look to assume more risk when the market sentiment is risk-on, and look to take on less risk when the market sentiment is risk-off. This has a very fundamental approach to trading certain asset classes that are regarded to be riskier assets than others. So perhaps equity markets, perhaps the Japanese yen, which we regard as a risk-off approach, and perhaps something like gold or oil, perhaps some of these commodities where we see a sharp level of risk enter the markets. We see money move towards these markets in question. And obviously, in the short term, we see a rapid movement in price. This dictates volatility in short term, and this actually paves the way for some discussion on short-term trading. Um, a lot of traders or speculators actually enter the markets only based on trying to trade volatility in the short term. In terms of discussing and trading volatility, we know that news affects the forex markets, news affects all sorts of financial assets, and this volatility actually paves the way for short-term opportunities. Many speculators trading the financial markets now focus only on trading the market in the short term, and we refer to this trading strategy as scalping, where traders aim to make a large number of short-term trades over the short term, perhaps in one trading day, all with the objective of making many small profits. This is possible entirely, of course, as news events and the release of economic data offer a continuous cycle of short-term opportunities across many different asset classes. So let's not forget, all of these news events in particular, they don't just affect perhaps one particular asset class like the forex pairs. Even though most of the news data will be more reflective of perhaps the global economy or macro events like CPI or gross domestic product, or perhaps unemployment, we also get economic data, perhaps like oil figures or a level of supply output in the oil market, which obviously in turn will affect solely an asset class like a commodity like oil. So it is indicative to actually know your research, know and understand what news events affect which asset classes and which are going to be more volatile in reflective to those news events. The forex markets often offer the best opportunity, however, for these traders as they constantly react to news available in the markets with volatile price movements. And that's why we say that the forex markets are perhaps the most volatile over the long term, and actually give us the most opportunity in trading. Here we have a typical trading day, and we can see we have a 24-hour trading day here from left to right. Starting from 12:30, we have highlighted there in very different colors there, red to yellow to orange, and these would indicate to perhaps the day trader which news events are of keen or more particular interest in the short term. We can actually choose to trade some of these pairs which are totally uncorrelated, just given the actual news figures. Perhaps we were deciding to trade the Australian dollar. We know that at 12:30 we have some news events affecting unemployment change and unemployment rate. They're regarded as red or of high significance when deciding to trade these forex currency pairs. Then perhaps if we go down to decide to trade the sterling or the pound sterling across different currency pairs, we know that we have retail sales, we have the official bank rate with the monetary policy and their summary as well. So we could see some very strong economic data that perhaps could offer some good trading opportunities in the short term. And if we're short-term traders, we will be looking at our trading platform to look and observe for this opportunity just to perhaps make some short-term price speculations or short-term trades for very quick profits. That is most certainly a very, very effective trading strategy for many traders. In terms of the news events and volatility, we know that we can see here by observing the forecasts on the right-hand side over daily news events. We have an actual figure or a forecast, and markets will experience increased volatility if economic figures either beat or miss market expectations. So perhaps we have a level of unemployment that is perhaps 5.6%, and we get the actual figure 7% unemployment. Obviously, that's going to cause a lot of concern for market participants trading this market and is going to cause large price increases. So a lot of these moves are actually or in relation to the actual forecasted figure by market analysts in comparison to what is actually announced and how the economies are performing. So what we do, we actually will look at trading a volatility with a practical example. We'll look at this policy decision by the Bank of England with the official bank rate and look to trade this perhaps over the short term by looking at the UK FTSE 100. We will look at the cable market, otherwise known as the pound US dollar, and perhaps the euro pound. Today we have a very important economic announcement today with the MPC official bank rate votes and the monetary policy summary. That will be the official bank rate of the Central Bank of England, and that is certainly to move markets. So what we'll actually do, we'll look to analyse this price volatility over the Forex markets, and we'll look at the UK FTSE 100 as well. Why do traders care when analysing the markets and looking for volatility? We know that this has a very short-term effect on currency valuation, and different asset classes will react as a result as well. So let's look at our FTSE 100 UK FTSE 100 chart. This is with market capitalization. We look to the FTSE 100 as the largest equity index in the UK, and it's more of a fundamental approach to how the economy is actually performing. Then we'll look at some of the forex pairs here with the euro pound and the pound dollar. We can see that it's 11:59 with 40 seconds into the minute, so we have around 20 seconds here just before our economic data is going to be announced to the market. We'll see with a 5-minute chart here, first of all with the euro pound, as to how this price action will react in the very, very short term. We'll then look at 1-minute candles as well. So we can see already some volatility approaching, and we see an explosive move to the downside as soon it's almost 2 seconds after 12. We see a very explosive move of price action as the bears really push that market down. We see the volatility there, and given the price is jumping down and bursting back up, we see that very much in the short term it's going to be reflected across the currency pairs. We can see this again in the pound US dollar. It shows a big spike, and that's generally what happens with these economic figures, a large spike in the market, and then there's a retracement while then the market continues to trade. We then look at the UK 100 here. We can see the FTSE is not showing a lot of volatility, so that is actually relevant to us in terms of deciding a preference to trade perhaps the forex pairs. We can look at it even in a 1-minute chart as opposed to our 5-minute chart there, and we see much more volatility in the forex pairs themselves, particularly in obviously pound sterling against the euro and the dollar. We see with the 1-minute chart, looking at the price action, we can see how volatile it is in terms of just the ATR of the actual candle. We see it spike the whole way down and actually retrace up to more than 50% of that actual candle, and then we're almost trading down strongly to the relevant price action with 1 minute and 30 seconds into the economic announcement. So it's a very difficult situation in terms of approaching the markets, whether you want to be a long-term trader or a short-term trader. And you can see that there is more opportunity when discussing volatility in the short term in reaction to actual news just entering the market. There's a lot of indecision there with both buyers and sellers reacting to the news. What does it mean perhaps for the markets? They're both buying and selling. I know that a lot of traders are taking winners and losers, so there's a lot of psychology into this volatility. And you can see now that we're actually starting to get 2 minutes into the news event, some retracement with perhaps a first bullish candle. Going back to the news event itself, we can see the actual figures that have been announced with an unchanged bank rate. The asset purchase facility is unchanged at 435 billion, and the monetary policy votes were 009, a unanimous vote for a non-change. So when we look back to our asset classes, we can see the volatility is absolutely extensive in terms of the trading range for the forex pairs in relation to very, very low volatility with the UK 100 equity index. After observing the volatility across different asset classes, particularly European or UK asset classes there, we observed the UK FTSE 100, the pound against two different currency pairs. We can see that the forex pairs were much more volatile in comparison to the equity index. That leads us on nicely to actually discussing asset class volatility. Each separate asset class itself share very different characteristics in deciding price movement. Market participants trade and may choose to trade them in different ways. They can decide to trade less volatile markets with a more fundamental long-term approach, or choose to perhaps take advantage of short-term volatility without actually having a view on the long-term direction of the market. Equity markets volatility will better represent an overall view of the market sentiment and risk. This is because equities will generally present a view of to economic performance within that particular region, whilst volatility in a particular commodity may only be applicable to that commodity itself. We often see this in soft commodities like wheat or sugar or perhaps coffee, etc. So many of these soft commodities actually don't trade with in accordance to economic news at all. If there's a crop report, of course, they will have very volatile price shifts. Perhaps if there is a storm or something affecting the supply or demand of the commodity itself, we'll see strong volatility enter the market. But if there's, of course, perhaps an economic data figure like unemployment report, that is not going to affect the price of wheat or sugar, of course, and they will trade off their own accord. As individual traders, we can decide which assets we prefer to trade in relation to our individual appetite for risk. And that's entirely an individual choice for the trader. We know during this lesson, when we observe many different asset classes, that perhaps the cryptocurrencies are much more volatile than the forex pairs. Perhaps trading the forex markets are much more volatile than some commodities, or perhaps your appetite for risk isn't such that you want to take these short-term volatility trades. You want to formulate price discovery over a much greater long term. Perhaps you would suggest or prefer to trade commodity markets if that is the case. So the choice is necessarily yours as an individual trader. We can look across markets like gold, equity markets, and bond markets as well, cryptocurrencies. So that allows us a lot of different trading strategies to apply to volatility, to apply to risk assumption across the asset classes themselves. So that concludes our webinar on discussing trading volatility. With a quick webinar review, we discussed what is volatility and defined it within the markets. We looked at its association with risk and risk assumption, and obviously as a trader over the long term, there is market sentiment in deciding whether the market is assuming a risk on or risk off approach. We assessed volatility with news and economic data, and obviously I looked at a practical example looking at the FTSE 100 as a UK equity index. We looked at the forex pairs they're related as well, and seen a stark difference in volatility given an official bank rate decision. Then we looked and discussed with a particular discussion on an individual choice to actually deciding to trade volatility over different asset classes. And it is with that your assumption whether you want to trade in the short term or long term can help you make those trading decisions. So thank you very much for joining us on this installment of Courses on Demand by Forex.Academy. We do hope to see you very soon. Bye for now.